All right, everybody. So we are starting with the last chapter for intermediate one for this spring semester. And so, this there's a lot of detail, kind of a lot of little sort of mini things we need to look at as we kind of go through each one. This first lecture, we're going to really focus on the cash portion. It's largely conceptual. And then when we get into receivables, there's going to be some concepts, but there's also going to be a lot of, sort of calculations and journal entries and things like that. And so, I'll try to keep each of these to about 15 minutes. I kind of have my clock in front of me here so that none of the lectures get too long, but we'll kind of jump right into it. So basically, if your textbook, kind of as you move forward through the rest of the textbook, you're really going to kind of walk through the balance sheet. That's essentially what's going to happen from chapter 7 to 18, starting with cash and receivables in this chapter. And then as you go into intermediate 2, and then even into intermediate 3, you're going to get into, other aspects of that balance sheet. And so that's really kind of the way we go through the rest of the textbook. Now, when we talk about chapter 7, which is cash and receivables, these are kind of usually those first two accounts, absent short-term investments, but they are, highly liquid. And so, you got to spend a lot of time, kind of walking through how we account for them. But the biggest thing with cash, really it's internal controls and how it's presented. And so we're going to kind of walk through those things. But with receivables, now we get into a little more kind of calculation-based types of things. All right, so what is included in cash? And so there's cash, and then there's cash equivalents. And so what is cash? So basically, currency, coins, balances in things like checking accounts, or things that are, getting ready to be deposited into these accounts, like checks and money orders and things like that. Those things that are essentially completely insulated from any sort of risk, and essentially are cash or can be used as cash. Now, cash equivalents is a little bit different in that, it's not just the coin and currency and checking accounts, but it does include other things like money market funds, treasury bills, and even some commercial paper. And so it doesn't have to be tangible cash to be equivalent to cash, but there are some caveats for it to be considered a cash equivalent. First, it has to be readily converted to cash for a known amount. So there's got to be a known amount, which maybe that's not a high threshold. But the other thing that I think is a little more stringent is that it has to be so near to maturity that there is a little risk of loss. And in that case, it's deemed equivalent to cash. And we talk about so near to maturity. I want to be clear, though, that the investment had to have an original maturity of 3 months or less. And so like a treasury bill, a 3-month treasury bill would qualify as a cash equivalent, but a 12-month would not. Same thing with commercial paper. When it was issued, if it was a 3-month note, then it can count. But if it's more than 3 months, then it could not count as a cash equivalent. And so it is pretty stringent on that criteria. Something like a money market fund, that's essentially always liquid, but it does have more risk because obviously currencies can fluctuate a little bit. All right. So when we talk about internal control, what is it, kind of what are we trying to focus on here? So there's really kind of 4 aspects. First of all, there has to be a plan in place that will encourage adherence to company policies and procedures, promote operational efficiency, minimize error and theft, and then really kind of, I'd say, where accountants really, I think, play an important role here is it enhances the reliability and accuracy of accounting data, because we know that ultimately we have all these inputs into an accounting system, and we will make sure those inputs are accurate, reliable, and then the output financial statements are reliable. And so, I'd say the A, B, and C are sort of what I would say cross-discipline, whereas D really is the accounting function. And so we do have the Committee of Sponsoring Organizations, or COSO. How do they define internal control? It's a process undertaken by entity boards of directors, management, and other personnel, and it's really designed to do a few different things. So first of all, you want to promote effective and efficient operations. You want reliable financial reporting, and you want compliance with applicable laws and regulations. And you can see there's a lot of overlap sort of in the, sort of broad strokes of what internal controls mean in the context of accounting, and specifically how COSO defines internal controls. And so again, we talk about these, obviously for accountants, our main focus is going to be reliability of financial reporting, but also these other factors are important just as well. But again, this is sort of getting you to some of this, kind of list kind of thing. All right, so let's talk about cash receipts, and my face might be black on the receipts part, so I apologize for that. But we talk about receiving cash. So what are we worried about when we talk about internal controls when we're receiving cash? So first of all, it is highly susceptible to theft, both physical cash or electronic cash like a checking account. And so you need to make sure that your internal control system is designed in such a way that that risk is minimized. And so when we talk about that, what's most critical, it's really about separation of duties. And what we mean by separation of duties is that, certain folks might have physical responsibility for cash or the checking account or whatever. Like they're the ones that, kind of keep the records, that actually handle writing checks and handling the cash and things like that. You do not want those same people to have access to the accounting records, or especially control over them. And so we need to separate who has responsibility for the cash and who is accounting for the cash. So we have to separate those duties. And so as an accountant, it's your job to understand the internal control system, and make sure those duties are separated. And a lot of times, especially in a small business, you may walk into the situation and the owner might say, hey, you're going to handle all of it. My argument for your own sake is to say, no, we need to separate these duties. I will either be the one that writes the checks, or I'll be the one that reconciles and keeps the checkbook and all that kind of stuff, but I'm not going to do both. And that's just to protect yourself, not necessarily that you would steal, but from any possibility of being accused of impropriety. So, and so just make sure that you kind of protect yourself in creating that. So as an example, when I moved to a neighborhood in Indiana, they wanted me to be the treasurer for the HOA. And at that time, the treasurer could write checks and also kept the checkbooks and things like that. And my argument was, okay, at a minimum, and they were kind of hesitant because it's a small neighborhood and people didn't want to bother. But I just said, listen, here's what we're going to do: is the president is going to be the one that is going to receive the statements and vet them. So in other words, the president is going to review everything along with me. And so there were two of us that had check writing ability and two of us that had the ability to review the financial statements. And so at least there was some oversight there. I would have preferred us to have complete separation of duties, but they'd been doing it the same way for a long time. It's like, well, at a minimum, we're both going to review everything every single month. And so so while you can look for a perfect situation, that always doesn't happen. But again, when you are able, you want the person who controls the cash to be different than the person who actually writes checks and reconciles balances and things like that. All right, so disbursements. So now we're talking about payments. And so the key concern here is unauthorized payments. In other words, whenever there's a payment, like for utility bills or whatever, you want to make sure that it's the company's utility bills and not the CFO's personal utility bills. And so, how do we control for that? And so one way you can do it is that that payment should be made by check. That way there's a paper trail. And furthermore, usually, again, if you've separated some duties, at a minimum, probably the owner of the business or a person in a different position is the one authorizing checks. And so at a minimum, it gives a paper trail. But if it's cash payments, like literal cash payments, then it can it can be problematic. And probably in class, I'll go over some examples where this has been a problem, at least that I've observed. Obviously, since this is going to be on YouTube, I'm not going to do that here. But separating those duties, making sure that there's no unauthorized payments is absolutely critical. Okay, again, kind of having everything sort of separated out to minimize unauthorized payments is important. So the other thing too that helps with disbursements and also receipts is reconciliation of books. So there's, what the bank says that you have, and then there's what your checkbook says that you have. Making sure that those two can be reconciled is really important. In some classes, I know some professors will do bank reconciliations and actually show you how to do that. We're not going to do that here, and one reason why is because there's only so many hours, right? And so one thing that I want to do is focus your attention on, some of the other things in this chapter. And so I just kind of made a choice to limit our coverage of bank reconciliations, but it is a skill you should develop and something you should figure out, you should learn how to do on your own. All right, one important concept when it comes to cash and cash equivalents is restricted cash. So sometimes cash can be set aside for a specific purpose and is not available for general use. And that is called restricted cash. And so how do we handle restricted cash? Usually it's going to be reported as a non-current asset. And so essentially, if cash has been set aside for a specific purpose and it's not available, then it cannot be counted as a current asset. Well, the reason this is important is because then it's not counted as a liquid asset, and it's important in calculating, the current ratio, the quick ratio, if you remember that from the balance sheet chapter. And so it's not included in some of those calculations. And so it's important that any restricted cash is designated differently than regular cash and cash equivalents. Restrictions can be voluntary. So sometimes management might be intending to use it for something else, like a future plant expansion or paying off a bond or something like that. If the company is voluntarily setting aside cash, then it's going to be classified as non-current. Now, sometimes restricted cash may arise from contracts. And so with the contracts, it's a little more, it's different. And so these legal restrictions are, enforced from a contract. And the key here is, I probably should have put it in purple. But if the contract is arising from a current liability, then that restricted cash is still a current asset. Now it's separate from cash, it's restricted cash, but it would be current. And if the liability is as a non-current liability, then that cash, restricted cash, would be non-current. So voluntary, always non-current. Contractually imposed, it depends on the maturity of the liability that it's tied to. A current liability means it's a current asset. Non-current liability would be a non-current asset. All right. What is a compensating balance? All right. So this is a type of restriction on cash, but a compensating balance basically is if I borrow money from a lender, sometimes they will require that you maintain a minimum balance at that institution. So a lot of times, especially if you borrow money at like a credit union to buy a car, they'll require that you open a checking or a savings account and that you leave some minimum amount of money in that account. And so obviously that is a restriction. I can't take that money out and use it for something else. And so, so again, it's a completely legal restriction, and that compensating balance is now a form of restricted cash. So essentially, if you kind of think about it, it really does create kind of an artificially higher effective interest rate, because when you borrow, so let's say that I am borrowing, let's kind of keep it simple, like $1,000 personal loan, but the bank requires that I put $100 into an account. Well, essentially, my net is 900. And so, while I still have the $100, the reality is my use is restricted. And so, if that $100 is in a non-interest bearing account, that essentially the cost now is a little bit higher, because now I'm foregoing interest or paying interest on a higher amount, on the full 1,000, even though I'm only using 900. And so, it kind of effectively increases the interest rate on any borrowing that you're doing. Again, classification is a little bit dependent when it comes to a compensating balance. If the restriction is legally binding, meaning that you default on the debt if you withdraw that cash, then it's again linked to the classification of the debt. So if it's a current liability, the restricted cash is a current asset. If it's a non-current liability, the restricted cash is a non-current asset. So again, if that's legally binding, it depends on the classification of the related debt. If the restriction is informal but not contractual, then actually that compensating balance can be included in cash and cash equivalents with some sort of note. So again, then at that point, it's just a checking account. But you'd have to note that, you know, there was this informal restriction. Okay, so I think I got my 15 minutes. We will pick up with current receivables with the next lecture.